You may think that the system governing the modern world was born in London, or that it began on Wall Street. What if I told you it wasn't? The system that governs the world today began in a city built below sea level, Amsterdam. The land was small, the population limited, natural resources were scarce, and yet, by the mid-1600s, it was the center of global trade. How was that possible? The answer was not in land, gold, or military power. It was hidden in a quietly unfolding financial revolution. The Dutch built power through trust and financial engineering. This was happening for the first time in history. It was also the beginning of the modern world. Welcome to Code 404, Economy, where the historical codes of money are revealed. The truth is always hidden in the details. When we think of the 1600s, we imagine kings, empires, and conquests. But the Netherlands was the exception of its time. It had neither a king nor an empire, nor did it possess natural wealth or gold mines. It only had merchants, and something more powerful than what its rivals possessed: trust. 400 years ago, while European monarchs were raising taxes to finance wars, the small Dutch Republic was doing something far more dangerous. It was turning risk into a product. In 1602, they founded the world's first joint stock company, the Verenigde Oostindische Compagnie, the Dutch East India Company. Now you no longer had to sail across the ocean to become wealthy. You could buy a share of a voyage and sell it the next day. Trade became liquid. Risk became tradable. Wealth, for the first time in history, detached from labor and became abstract. Investors could buy shares in the company and sell them to someone else. After a while, these shares began to be traded on an exchange. Prices rose and fell according to rumors and profit. And that is how the stock market was born. The VOC expanded so much that it gained the authority to mint its own currency, maintain its own army, and declare war in distant lands. This was the first example of capital becoming not just a commercial force, but a state power. But it did not end there. Dutch merchants traded on credit. They trusted paper rather than promises. And to manage this entire system, an institution was needed. In 1609, they established the first modern central bank. Before this, Europe's monetary situation had been chaotic. Every city minted its own currency. The Bank of Amsterdam provided a solution to this disorder. Coins were deposited in the bank and recorded in ledgers. Thus, money was properly weighed and verified. This bank money was considered more reliable than gold itself. With the trust this created, Amsterdam's trade expanded enormously. Merchants from across Europe opened accounts at the bank. Governments borrowed from it. For the first time in history, the idea that trust could replace metals, long considered the most reliable store of value, became reality. This trust attracted capital to Amsterdam. Trade reached unprecedented levels. The Dutch were not only trading goods through this system, risk itself became a subject of trade. They invented forward contracts for cargo carried on voyages, options for prices. They insured expeditions, and thus the insurance system was born. There were wars as well. The Dutch Republic was engaged in a struggle for independence against Spain. War required financing. Historically, states facing this situation either raised taxes or debased their currency. The Netherlands chose an entirely different path. It issued bonds. It told the public, "Give us money today. We will pay you interest in the future." This created a continuous and potentially unlimited system of public borrowing. The public trusted the state because the tax system was transparent. The financial markets were active. As a result, the Netherlands became the state that could borrow at the lowest interest rates in Europe. Low interest meant cheap war financing. This was an extraordinary advantage. By the mid-17th century, the Netherlands was not only wealthy, it had become Europe's financier. Government bonds were reliable. Amsterdam's markets were liquid. Dutch investors could even lend to other states. While financing its war against Spain, the Netherlands was simultaneously reshaping the balance of power in Europe through credit. Power no longer came from land, but from capital flows. This was the first financial hegemon of the modern world. The Netherlands' success was not only hidden in numbers, but in the rule of law. While, across Europe, kings arbitrarily erased debts or confiscated merchants' goods, Amsterdam sanctified property. Through the courts, a merchant could defend his rights even against the state. This legal security caused capital to leave its homeland and take refuge in Amsterdam's harbor. Money is not always cowardly. Money prefers places where the rules are clear. The Dutch had built a model. The model seemed perfect, and it worked almost flawlessly. But beneath the system, an invisible risk was progressing. The Netherlands was detaching from production. There was an excess of capital, but that capital was being invested abroad. The Netherlands produced less, financed more, and earned returns through interest. This system was highly profitable in the short term. But declining production capacity was a warning for the long term. Meanwhile, England was watching the Netherlands closely. After years of war with France and mounting debt, In 1694, England copied the Dutch model. The Bank of England was established, banknotes backed by government debt were issued, and a national bond market was created. The credit system was deepened. In addition, England combined the Dutch model with industry. While the Netherlands was primarily a center of trade and credit, England moved toward the Industrial Revolution and increased production. Following these developments, London gradually began to replace Amsterdam. This was a shift in power. By the 18th century, Europe was discussing who could finance wars. Thanks to the Dutch model, England could now build larger navies. It was more resilient in prolonged wars. It could sell more bonds. The Netherlands was still wealthy, but it was no longer the center of the system. As the 18th century progressed, stagnation began in the Dutch Republic. Having grown rich through the model it created, the Netherlands fell into complacency. Wealth flowed not into production, but into financial instruments. Dutch bankers distributed loans to foreign countries. Amsterdam transformed from a trade hub into a place sustained by interest income. Yes, the Netherlands did not experience a sudden economic collapse. Its currency did not crash. Its banks remained standing, but it lost its dominance. Amsterdam lost its position as the center of trade. London took its place, and when London slowed, New York did. This, too, is a cycle. The system invented and established by the Dutch Republic is still alive today. Government bond markets, central bank discipline, publicly traded corporate structures, stock exchanges, and continuous borrowing. The roots of the modern world economy extend back to the model initiated by this small country in the 17th century. When London took over the center, Britain globalized the system. America expanded it with the dollar. But the core idea remained the same. Power comes from credit, and credit depends on trust. Mistakes repeat as well. Not identical, but essentially copies. Today, the data flowing into terminals on Wall Street circulated in the smoky coffee houses of Amsterdam in the 1600s. Information was the most valuable asset. News of a ship sinking or a new spice route being discovered reached the coffee houses before it reached the harbor. It was here that some of the darkest and perhaps most profitable tools of modern finance were invented: short selling. Ambitious merchants like Isaac Lemaire began selling shares they did not own, expecting prices to fall. This marked the beginning of the first major financial manipulation battles in history. People were no longer buying a physical good, but a possibility. The Amsterdam Exchange was not merely a trading venue. It was the first laboratory where psychology, panic, and greed were transformed into a mathematical model. Modern humanity's obsession with watching charts on screens began 400 years ago with merchants waiting over a cup of coffee for news from the harbor. In the 1600s, tulips imported from the Ottoman Empire became a status symbol. Fortunes were paid for bulbs that had not yet bloomed, and contracts for them were traded like shares. When tulip mania reached its peak, the prices of tulip bulbs were astonishing. People were not buying flowers. They were buying the promise that someone else would pay a higher price tomorrow. But one day came when no one was willing to pay more. The bubble burst. Tulip mania was the first speculative bubble in history, but it was not the last. The South Sea bubble in 18th century Britain, the Mississippi Company bubble, the dot-com bubble, the roaring stock market of the 1920s in the United States, followed by the Great Depression, the 2008 housing crisis. Different periods, different assets, but the same story. The modern world system was not designed to prevent bubbles. It was built to continue after they burst. Today, global debt is at record levels. Financial markets are based more on belief than production. Stock markets rise and fall on speculation. The tools and names are different, but the path is the same. The system built to manage risk has itself become the greatest risk. The Dutch Republic proved something to us. A country with small territory can still become a superpower. But sustaining financial power requires constant competition. And the moment you stumble, the center shifts elsewhere. Before Britain, there was the Dutch. Before the dollar, there was London. The history of finance is the history of the distribution of power. And perhaps the question we must ask today is, when the time for change comes, where will the new center be? If this video gave you a new perspective, subscribe. The answers are hidden in history's codes. We reveal them.